All right, listen up. The market, as you've probably noticed, it's been doing its thing again, bouncing around like a pinball. One minute it's up, the next it's down, and if you're anything like me, you're not just watching the numbers tick by, you're trying to figure out why this is all happening. Because let's be honest, knowing the what is one thing, but understanding the why, that's where the real edge is. That's where you start to anticipate, to strategize, to actually make some money in this crazy game. Today, we're going to peel back the layers on some of the biggest market movers we've seen recently. We're talking about the latest pronouncements from the White House, the never-ending saga of the China trade talks, and that big, looming decision from the Federal Reserve that everyone's holding their breath for. These aren't just isolated events. They're interconnected pieces in a much larger puzzle, and understanding those connections is key to navigating the days and weeks ahead. So buckle up, because we're about to dive deep into the forces that are shaping the market right now. Now, let's talk about this glorious, never-ending saga of the Trump-China trade talk roller coaster. It feels like we've been on this ride for years, doesn't it? Just when you think things are settling down, bam, another headline hits, and the market reacts like it's the most groundbreaking news since the invention of sliced bread. And the latest chapter? Well, it's a classic. We've had whispers, then confirmation, then a bit of back and forth, all centered around the possibility of resuming trade negotiations with China. And the market, bless its easily excitable heart, it jumped on it. Stocks rallied, futures went green, and for a brief moment it felt like maybe, just maybe, we were on the cusp of a breakthrough. But here's where the skepticism needs to kick in. Because if you've been paying attention, this isn't the first time we've heard this tune. Think back to when Trump first started talking about tariffs. Remember the initial shock, the fear, the market sell-off. And then remember the subsequent announcements about potential talks, about goodwill, about progress. The market reacted positively then too. It was a pattern. Announced tariffs, market tanks. Announced potential talks, market rallies. It was almost predictable. And what we're seeing now, this sudden burst of optimism about resuming negotiations. It feels eerily similar. Is this genuinely new information? Is there a tangible shift in the landscape that warrants this level of excitement? Or, as I'm inclined to believe, is this just more of the same? Are we being fed the same narrative, gusset up in slightly different words, to elicit a specific reaction from the market? It's a valid question to ask. Because while the idea of a resolution to the trade war is certainly appealing, and it would undoubtedly be a net positive for the global economy, we've been down this road before. We've seen these promises of progress evaporate into thin air. We've seen the goalposts moved, the demands shifted, and the negotiations stall. So, while it's easy to get caught up in the hype, it's crucial to maintain a healthy dose of skepticism. We need to see concrete action, not just hopeful rhetoric. We need to see signed agreements, not just promises of future discussions. Until then, this latest rally feels like a knee-jerk reaction to a familiar script. It's the market hoping for the best, clinging to any shred of positive news in a somewhat uncertain environment. But hope isn't a trading strategy. And relying solely on these announcements, without questioning their substance, can be a dangerous game. So while the headlines are buzzing about resumed trade talks, let's keep our eyes wide open. Let's remember the history of this particular negotiation. Let's remember how many times we've been here before, only to see the optimism fade. Is this the time it's different? Maybe. But I'm not holding my breath. The market's reaction, while significant, tells us more about the prevailing sentiment, a desperate desire for good news, than it does about the actual likelihood of a swift and positive resolution. We've seen this movie before, and the ending hasn't always been happy. So let's appreciate the temporary lift, but let's not mistake it for a fundamental shift. The trade war is far from over, and this latest development, while generating headlines and market movement, might just be another act in the same old play. We've got to be critical, we've got to be discerning, and we've got to avoid getting swept up in the hype without solid evidence to back it up. The market loves a narrative, and this trade talk narrative is a powerful one, but we need to look beyond the headlines and examine the underlying reality. Is there substance to this? Or is it just the same old story, designed to move the needle in a predictable way? My money is on the latter, at least for now. We've been burned before, and it's wise to remember those lessons. The market is a fickle beast, and it can turn on a dime, especially when the positive news turns out to be less substantial than initially advertised. So, while the recent rally was certainly a welcome sight for some, let's not forget the context. Let's remember the history. And let's approach this latest development with a healthy dose of skepticism. It's the same until proven otherwise. And proving otherwise requires more than just headlines. It requires action. Now, let's shift gears and talk about something that really gets the market's attention, the FOMC rate decision. This is the big one. This is the event that can send tremors through the financial world. The Federal Reserve, specifically the Federal Open Market Committee, they're the custodians of monetary policy in the United States. They decide where interest rates are headed, and that decision has ripple effects across the entire economy, from the cost of borrowing for businesses and individuals to the returns you can expect on your savings. And right now, the market is fixated on their upcoming meeting. Why? Because the trajectory of interest rates is a massive factor in determining the overall health and direction of the market. Lower rates generally make borrowing cheaper, which can stimulate economic growth and make stocks more attractive relative to other investments. Higher rates can have the opposite effect, making borrowing more expensive and potentially slowing down the economy. So, what are the expectations for this upcoming meeting? Well, if you look at the Fed Rate Monitor tool, which is a fantastic resource for gauging market expectations, the probability of a rate cut is extremely low. We're talking single digits here. The overwhelming expectation, and this is where the market is currently positioned, is for a pause. The Fed is expected to hold rates steady. They're likely to keep them where they are, taking a breather after a period of significant rate hikes. This pause is seen by many as a sign that the Fed believes inflation is coming under control and that the economy is on a relatively stable path, even if growth is slowing. Now, let's consider the potential market reaction to these scenarios. If the Fed were to surprise everyone and cut rates, we'd probably see a rocket ship. The market would interpret that as a sign that the Fed sees significant weakness in the economy and is stepping in to provide support. That kind of unexpected stimulus would likely send stocks soaring. However, as I mentioned, the probability of that is very, very low. The more likely scenario is a pause. And how would the market react to a pause? This is where it gets interesting. While a pause might sound neutral, the market's initial reaction could be a bit of a de-risking event. Think about it. The market has been priced for a pause. It's been anticipating this outcome. So when it actually happens, there might not be a huge positive surprise. Instead, some investors might take profits, feeling that the expected catalyst has now passed. There might be a slight pullback as traders reevaluate their positions. It wouldn't necessarily be bearish, but it might not be the strong upward movement that some are hoping for. It's more of a "okay, that happened, now what" kind of reaction. The market has been building up to this moment, and when it arrives as expected, the immediate impact might be less dramatic than you'd think. It's the classic buy the rumor, sell the news scenario, but in this case, the news is the expected outcome. Now, what about the possibility of a surprise cut? As unlikely as it is, it's worth considering. If the Fed were to cut rates, it would signal a significant shift in their outlook. It would suggest they see something concerning in the economic data that the market hasn't fully grasped. And while an initial reaction might be positive due to the stimulus, it could also raise questions about the underlying health of the economy. A surprise cut could be interpreted as a sign of desperation, not strength. So, while the initial reaction would likely be bullish, the longer-term implications would be more complex. The key takeaway here is that the market is highly sensitive to the Fed's every move and every word. The language used in the FOMC statement, the press conference that follows, it will all be dissected by analysts and traders. They'll be looking for clues about the Fed's future intentions. Are they done hiking rates for good? Are they signaling a potential cut in the future? Or are they keeping their options open? All of these nuances will influence market sentiment and drive price action. The Fed is essentially the conductor of the economic orchestra, and their rhythm dictates the market's dance. Understanding their likely moves and the potential reactions to those moves is crucial for anyone navigating the markets right now. The anticipation of this decision is building, and the actual announcement is likely to be a major market-moving event, even if the outcome is exactly what everyone expects. The devil is in the details, and the market will be scrutinizing every word for hints about the future. Let's talk about timing. Because in the world of markets and politics, timing is often everything. And if you've been paying attention, you might have noticed something interesting about the timing of some recent announcements, particularly those coming from the Trump administration regarding the China trade talks. They seem to have a knack for dropping these bits of news right before significant market-moving events, don't they? And this latest flurry of activity around resuming trade negotiations. It happened just ahead of the highly anticipated FOMC rate decision. Is that a coincidence? Or is there a deliberate strategy at play here? It's a question worth asking. Is the administration strategically timing these announcements to influence market sentiment before the Fed makes its decision? Think about it. A positive headline about trade talks, even if it's just about resuming discussions, can inject a dose of optimism into the market. It can create a sense of hope and potentially lead to a rally. And a market that's feeling optimistic, a market that's trending upwards, might make the Fed's decision seem less critical, less urgent. If the market is already in a good mood, the Fed might feel less pressure to act aggressively, to cut rates, for example. Conversely, if the market were in a state of fear and uncertainty, if it were selling off, the pressure on the Fed to provide stimulus to cut rates would be much greater. So, by releasing positive-sounding news about trade just before the FOMC meeting, the administration could potentially be trying to create a more favorable environment, a market that's less reliant on immediate action from the Fed. It's a way of trying to manage expectations and perhaps even subtly influence the Fed's decision-making process. Is this outright manipulation? That's a strong word, and it's difficult to prove intent. But is it strategic timing? Absolutely. It's a classic political tactic. Release good news when it can have the maximum impact, when it can serve a specific purpose. In this case, the purpose could be to create a sense of stability and optimism in the markets ahead of a key economic announcement. It's about controlling the narrative, about shaping public perception, and about potentially influencing the actions of other key players, like the Federal Reserve. Think about the potential benefits. A rising market can be seen as a sign of economic strength, which can be politically advantageous. It can bolster confidence and create a sense of positive momentum. And by tying that positive momentum, even indirectly, to the administration's actions on trade, they can potentially claim credit for it. It's a way of saying, look, we're making progress on trade and the market is responding positively. Things are good. Of course, there's also the possibility that it's simply good timing. Maybe the discussions about resuming trade talks genuinely reached a point where an announcement was warranted, and it just happened to coincide with the FOMC meeting. But given the history of these trade negotiations and the administration's clear interest in market performance, it's hard to ignore the potential for strategic timing. It feels too convenient, too well-timed to be purely coincidental. So as we approach the FOMC decision, keep this in mind. The market isn't operating in a vacuum. It's being influenced by a variety of factors, and the timing of political announcements is definitely one of them. Is it a deliberate attempt to influence the Fed? Is it simply leveraging a favorable moment? It's probably a bit of both. But understanding that these announcements aren't happening in isolation, that they might be strategically placed, can help you see the bigger picture and avoid being swept up in the immediate reaction without considering the underlying motives. It's another layer of complexity in the market, another factor to consider when you're trying to make sense of the seemingly random movements. Don't just look at the news. Look at when the news is being released and consider why now might be the opportune moment. All right, let's get into the weeds a little bit and talk about a specific trade example. Because hearing about market movements in general is one thing, but seeing how those movements translate into actual trading decisions and results, that's where the rubber meets the road. And one trade that was particularly interesting recently was the one I made on AMD, Advanced Micro Devices, around their earnings report. Now, AMD is a stock that's been on a tear, a real market darling, especially in the tech sector. They've had incredible growth, and their earnings reports are usually met with a lot of enthusiasm. And this time around, the initial reaction to their numbers was no different. The stock looked like it was going to pop. But despite that initial positive reaction, I decided to take a contrarian view. I chose to short AMD. Now, why would I do that when the sentiment seemed so positive? Well, it goes back to looking beyond the immediate headlines and considering the longer-term trends and the overall market sentiment. While AMD's earnings were strong, there were whispers, subtle shifts in Wall Street sentiment that suggested the easy money had already been made in the stock. There was a feeling that the valuation was getting stretched, that the expectations were incredibly high, and that any slight misstep or even just a lack of a blowout performance could lead to a pullback. Furthermore, I was looking at the broader market picture. I had a bearish outlook in the short term, and I felt that even a strong earnings report wouldn't be enough to overcome the potential headwinds in the overall market. I saw AMD as a stock that was ripe for a bit of a correction, especially after such a strong run. It felt like a classic buy the rumor, sell the news situation, but the rumor was the positive earnings and the news was the actual report, which, while good, perhaps didn't exceed the already sky-high expectations enough to justify further significant upside. So I initiated a short position on AMD. I was betting that the price would go down. And how did that play out? Well, after the initial positive blip, the stock price started to turn. The enthusiasm faded, and the selling pressure began to build. I monitored the trade closely, watching the price action and the overall market dynamics. And as the price moved in my favor, I started thinking about taking profits. It's crucial in trading to have a plan, to know when you're going to enter a trade, and just as importantly, when you're going to exit. You don't want to get greedy and let a profitable trade turn into a losing one. So as the AMD price dropped, I started scaling out of my position, taking profits along the way. I didn't wait for some arbitrary target. I reacted to the market and locked in gains as the opportunity presented itself. And ultimately, that AMD short trade resulted in a profit of 11,066.08. It wasn't a massive, life-changing amount, but it was a solid win, and it validated the contrarian perspective I had taken. It was a good example of how looking beyond the surface level, news and considering the broader market context and underlying sentiment can lead to profitable trading opportunities. It also highlights the importance of having conviction in your analysis, even when the initial reaction of the market seems to go against your view. Sometimes, the most profitable trades are the ones where you go against the popular opinion, but only if you have a solid fundamental or technical reason for doing so. This AMD trade was a good reminder that even in a strong stock, opportunities for shorting can arise, especially around events like earnings reports where expectations are often incredibly high. It's about finding those moments where the market's initial reaction might be an overreaction, or where the underlying sentiment is starting to shift, even if the headlines are still positive. Now, trading isn't just about the big wins. It's also about managing risk, and it's about acknowledging that not every trade is going to be a winner. That's just the reality of the game. And in the same period, alongside that successful AMD trade, I had a couple of other positions that are worth mentioning, both to illustrate the breadth of trading opportunities and to demonstrate the importance of transparency, even when things don't go perfectly. One successful trade I had was a short position on PLTR, Palantir Technologies. Palantir is another stock that's been in the spotlight, and like AMD, it had seen a significant run-up. My rationale for shorting PLTR was similar to AMD. I felt the valuation was getting a bit ahead of itself, and the overall market sentiment was leaning towards a potential pullback in some of the high-flying tech names. I saw an opportunity to capitalize on that potential correction. And that trade worked out well, resulting in a profit of around $4,200. It was another example of identifying a stock that I felt was potentially overextended and taking a position that benefited from a downward move. But as I said, not every trade is a winner. And it's important to be open about that. Trading involves risk, and sometimes, even with careful analysis, the market moves against you. That was the case with a trade I had on HIMX Technologies. HIMX is a semiconductor company, and I had taken a long position, believing there was potential for upside based on some technical indicators and overall market conditions at the time. However, the trade didn't play out as expected. The stock price moved against me, and despite my initial rationale, it became clear that the trade wasn't going to work out. This is where risk management comes into play. It's absolutely crucial to have a plan for when a trade goes wrong. You need to know at what point you're going to cut your losses. You can't just hold on indefinitely, hoping that the market will eventually turn around. That's a recipe for disaster. You have to be disciplined and accept that sometimes you're going to be wrong. That's not a sign of failure, it's just part of trading. The failure comes when you don't manage your risk, when you let a small loss turn into a big one. In the case of HIMX, I recognized that the trade wasn't working, and I made the decision to exit the position and take the loss. The loss on that trade was $927. Now, compared to the profits from AMD and PLTR, that's a relatively small amount. But it's still a loss, and it's important to acknowledge it. It's a reminder that trading isn't about being right 100% of the time. It's about managing your risk, about letting your winners run, and about cutting your losses quickly when a trade isn't working out. By openly discussing both the winning trades and the losing trades, I want to emphasize the reality of trading. It's not always smooth sailing. There will be ups and downs. But by having a solid trading plan, by focusing on risk management, and by being disciplined in your execution, you can increase your chances of long-term success. The $927 loss on HIMX was a learning experience, a reminder that even with a good process, the market can be unpredictable. But it also highlights the importance of keeping those losses small so that they don't wipe out the gains from your winning trades. It's all part of the process, and understanding that not every trade will be a winner is a fundamental aspect of becoming a successful trader. So, looking at the overall picture from the recent trading activity, including the AMD short, the PLTR short, and yes, the HIMX loss, the total profit for that particular day was around $17,000. Now, that's a good day, no doubt about it. And it reflects the ability to identify opportunities in the market, both on the long and short side, and to execute trades with discipline. But more than just the dollar amount, it provides a snapshot of the prevailing market sentiment and how I was positioned to capitalize on it. As I mentioned earlier, the market right now is in a fascinating state. There's this underlying desire for recovery, for things to get back to normal. There's a tendency to overreact to any hint of positive news, whether it's about trade talks or anything else that could potentially signal a turn for the better. It's almost like the market is desperately hoping for a reason to rally, to put the recent volatility behind it. This explains the quick and sometimes exaggerated reactions to headlines that might not have as much substance as they appear on the surface. The market is looking for a catalyst, and it's willing to jump on anything that even vaguely resembles one. However, despite this underlying hopefulness, my outlook in the short term remains bearish. I still see headwinds. I still see potential for further downside. The economic picture isn't entirely clear, and there are still risks out there that the market might not be fully pricing in. Things like potential slowdowns in global growth, ongoing geopolitical tensions, and the lingering effects of inflation. These are all factors that could weigh on the market. So, while the market might be prone to these bursts of optimism, I believe that the path of least resistance, at least for now, is still downwards. This doesn't mean I'm predicting a crash, but I think rallies are likely to be met with selling pressure, and there's a higher probability of seeing lower prices in the short term than significantly higher ones. This is why I've been focusing on shorting opportunities, looking for stocks that I believe are vulnerable to a pullback. It's about positioning yourself in line with what you believe is the most likely direction of the market. The $17,000 profit is a reflection of that bearish outlook. It came primarily from successful short trades, which benefit when the market or specific stocks go down. It's not about being right all the time, but it is about having a thesis about the market's direction and finding opportunities to trade based on that thesis. The market's sentiment might be leaning towards hope, but my analysis suggests caution is still warranted. The tendency to overreact to news while creating volatility also creates opportunities for those who can see beyond the immediate headlines and understand the underlying dynamics. The market's eagerness for recovery is palpable, but that doesn't necessarily mean a sustained rally is imminent. It just means that any positive news will likely be amplified, while negative news could be met with a more subdued reaction initially, before the reality sets in. It's a complex environment, but by understanding the prevailing sentiment and combining it with your own analysis, you can navigate it more effectively. The market wants to go up, but the fundamentals and the risks might still be saying otherwise. And that tension is what creates both the volatility and the trading opportunities. Now, looking ahead, especially to tomorrow, there's one thing we can pretty much guarantee: volatility. And specifically, volatility surrounding that big FOMC rate decision we talked about. This is not a day to be complacent. This is a day to be cautious, to be prepared, and to understand that market swings could be significant and rapid. For anyone, and I'm talking particularly to beginner traders here, this is not the time to be making impulsive decisions. This is not the time to be throwing caution to the wind. The FOMC decision is a major event, and the market's reaction to it can be unpredictable. Even if the outcome is what's expected, the language in the statement, the nuances in the press conference, they can all trigger significant movements. You could see a strong move in one direction, only to have it reverse just as quickly. This is the nature of trading around these high-impact events. So my strong advice for tomorrow, especially for those who are still learning the ropes, is to be extremely cautious. If you're not experienced in trading around major economic announcements, it might be best to sit on the sidelines. There is absolutely no shame in observing and learning without putting your capital at risk. In fact, for beginners, that's often the smartest approach. Watch how the market reacts. See how the price action unfolds. Understand the dynamics before you jump in. If you do decide to trade, make sure you have a clear plan, tight risk management, and you're only risking a small amount of capital. Don't overextend yourself. Don't take on more risk than you can comfortably afford to lose. The potential for big swings means the potential for big losses if you're not careful. Understanding the potential scenarios we discussed earlier, the pause, the cut, the surprise cut, and the likely market reactions to each is crucial. But even with that understanding, the immediate price action can be choppy and difficult to navigate. The algorithms will be running wild, and the market makers will be looking to capitalize on the volatility. This is why I'll actually be going live tomorrow. Being able to see the market in real time, to analyze the price action as it's happening, and to have a community to discuss it with, that can be incredibly valuable, especially during periods of high volatility. I'll be sharing my thoughts, my analysis, and potentially looking for trading opportunities as they arise. But the primary goal of the live stream, especially for beginners, is to provide a real-time educational experience. To show you how to approach these events, how to interpret the market's reaction, and how to stay disciplined even when things are moving fast. It's a chance to learn in a live environment, to see how an experienced trader navigates the volatility. So if you're feeling uncertain about tomorrow, or if you just want to gain some real-time insight into how these major events play out in the market, I encourage you to join the live stream. It's a valuable resource, and it can help you approach tomorrow's trading with more confidence and less risk. Remember, tomorrow is likely to be volatile. Be prepared, be cautious, and consider joining the live stream for real-time guidance and community support. Don't let the potential for big moves tempt you into taking on excessive risk. Discipline is key, especially on days like tomorrow. So as we wrap things up, I hope this deep dive into the recent market movers, the trade talks, the FOMC decision, and the overall sentiment has given you a clearer understanding of what's been happening and why. Understanding the drivers behind the market action is fundamental to becoming a successful trader. It's not just about watching the charts. It's about understanding the narrative, the catalysts, and the potential reactions. We've talked about the recurring pattern of the Trump-China trade talk roller coaster, the market's obsession with the FOMC decision and the potential scenarios, and the strategic timing of announcements. We've also looked at specific trade examples, like the successful AMD short, and the importance of acknowledging and managing losses, as demonstrated by the HIMX trade. All of this feeds into understanding the current market sentiment, that underlying desire for recovery tempered by ongoing risks and a tendency to overreact to news. And looking ahead, we've highlighted the expected volatility surrounding the FOMC decision and the need for caution, especially for beginner traders. This journey of understanding the market is continuous. It requires constant learning, adaptation, and staying informed. And that's where being part of a supportive community can make a huge difference. If you're serious about improving your trading and gaining a deeper understanding of the market, I highly recommend considering joining the LPP team. It's more than just a service. It's a community of like-minded individuals who are all working towards becoming better traders. With lifetime access, a comprehensive video library covering a wide range of trading topics, and live trading sessions where you can see real-time analysis and execution, it's a resource designed to help you navigate the complexities of the market. You get access to strategies, insights, and a community that can help you stay disciplined and informed. Remember, the goal is to finish the year strong, to make smart, informed trading decisions, to manage your risk effectively, and to continuously learn and improve. Understanding the why behind the market's movements is a crucial step in that process. So take what you've learned today, apply it to your own analysis, and continue to build your knowledge. The market is a challenging but potentially rewarding environment, and with the right understanding and approach, you can increase your chances of success. Don't just react to the headlines, understand the forces that are shaping them. And if you're looking for a community and resources to support you on this journey, consider joining the LPP team. There's a discount link in the description below. Let's aim for a strong finish to the year.